Hey guys, how are you? This is Ishai Breslower, your host of the CRE Shark Eye Show. We have a treat today. Because we have an expert of real estate investments for family offices. And he's basically an expert for that field. And we have so much to discuss, from asset classes, investments, to the prop tech scene that we have around the world. DJ Van Keuren, thank you so much for being with us today.
Hey, thanks for having me.
My pleasure. And you know what, before we even start digging into your story, if you could give us like a 2-minute elevator pitch of who you are, what is your business about, etc.
Sure. So DJ Van Keuren, as you'd mentioned, I've been in real estate for about 25 years. I came starting in 2003, just strictly focused on real estate, put together what was going to be the first single family REIT. Sold that off, seen a downturn coming, done some past experience with working with some major firms like Goldman and Carlyle, and doing some major projects in New York City, and then about 7 years ago moved to Denver, fell into the family office space, and worked for some prominent families on their real estate. It includes a billionaire out of Colorado here. There's also a owner of one of the professional Major League Baseball teams, and then also founder of Giorgio Perfume, Giorgio Beverly Hill. And then most recently, we've done some work with the Marriott family. So we strictly focus on real estate, now investing on behalf of numerous families on an invite only into opportunities, and then also focused on education for families and real estate.
Beautiful. Sounds like you're involved in so many things. You know what, before we get into this whole thing, tell us a little bit about how you got into this thing called real estate and everything else, and the family office. In, as you said, you started with the big firms and then you went to the little firms. I'd love to hear your story.
Well, I was, in the 90s, I was an advisor. I went over to Vietnam from 2003 to co-develop what today is the largest coffee company in the country. And when he decided to come back in 2003, I literally was sitting there in Saigon, and I'm like, what do I want to do? And I was like, well, I've always loved real estate. So that's where I dove into real estate. I read everything that I could. I mean, pretty funny, but everything from the late night gurus all the way to taking a course at Harvard in my program. So I literally went full circle for 2 years, just reading everything I could on real estate. And, it was, so that started my path into that, career on real estate. And then quite honestly, like 95% of the people that are in the family office space fall into the family office space. I wasn't looking to get into the family office space. I actually just started meeting people here in Colorado when we moved here, and happened to meet the president of a family office. And they said, look, when our patriarch dies, we're going to, all the money goes to the foundation, and we've got 90 people here that help create as well through real estate. So we need some outside capital. What would you recommend? So they were going to do a fund initially, and they said we can go, so I looked at it, and we can go the institutional side where all my relationships were, or family office. And I only knew 2 families at the time. And I said, you should go family office space side. And so literally probably within 6 months, I realized this is what I want to do finally, that I want to just focus on real estate and family offices. So fell into it, and haven't left, and will never leave.
It sounds exciting. I want to ask you something. And this is something that I used to be asked in the past, but meaning to have a guy like yourself is such a treat, because I'm going to ask you the question. What is the major difference between dealing with the big ones, with the big firms, right? The New York firms, the big firms, versus the family office scene. It's a very, very different dealing. If you could tell us a little bit about the experience, the day-to-day, the experience, the investment experience, the know-how, the processing, the bureaucracies that you can have there or here? I would love to
Got
hear
it.
that.
Well, I'll tell you, it's interesting because I've, for various projects, raised money from various areas. So the retail sector, right? Broker dealer area, to RIAs, to institutions and families. And the biggest thing that you have, families are much more like retail investors than they are institutions, which a lot of people find that very interesting, but it's true. And the reason why is because the institutional capital is not personal capital. That's coming from a third party. Now, you might be investing on behalf of a pension plan or whatnot, but you've got these people, they'll typically hire them out of college, grad school, MBA program, whatever, right? They're in their early 30s. It's more about, this is our box, this is our discretion, this is the property types that we look for. And this is on the institutional side, right? This is the returns that we need to get. This is how we're going to diversify, et cetera. On the family office side, the majority don't have an investment committee. They don't have a game plan for the most part. And it's personal, it's their own money. So it's not like that's why they're more emotionally like the retail investor. But what's interesting is that, you've got these people that spent their whole life creating hundreds of millions of dollars, billions of dollars. And our definition of a family office is worth 250 million or more. And they go through and now all of a sudden they have all this money. Well, they've spent their last 40 years in chemicals or tires or some other industry. And now there's no way that they're going to understand private equity, hedge funds, venture capital, technology, real estate, right? And there are people that will spend their whole life in one area. Maybe they do private equity, healthcare. Well, it's not just healthcare. It could be certain size or certain EBITDAs or even sub segments. And that's their whole career in one little area. So how can you expect somebody that has been building a business to understand that? And unfortunately, that's the same thing, when I said 95% of the people that work for a family fell into it, because all this money comes in and they're like, who do I trust? Well, I trust my accountant, I trust my banker, I trust my advisor, I trust, my neighbor, whatever the case is. And they don't have the knowledge in all those various capacities as well. So, the biggest thing is it's much more emotional. They don't have the box. Usually they don't have a big investment committee for the most part. And, there is that lack of understanding that's a lot more prevalent than people realize.
Tell me something. Does it also affect the deal types that they go after, asset classes and deal types? Meaning in terms of the difference between the large, meaning the family offices and the large firms?
Yeah, so we just started our 4th annual family office real estate investing study. It's the largest of its kind in the world. And so we've been actually being able to trend what families are investing into, how they're investing into, et cetera. And where the institutions primarily like, and international investors for that fact, the gateway cities, right? They like the San Franciscos, the New York Cities, the Miamis. Well, the majority of families are great with secondary markets, right? So they're great with the Denvers and the the Austin, Salt Lake City, Nashvilles. They're also fine with deals, which I consider the sweet spot, between 10 to $50 million. So you're looking at equity checks of 5 to 12, 15 million bucks. A lot of these major institutions won't write a check less than 20 million, right? And so it's from that perspective, the number one property type for families, again, is multifamily, followed by industrial. And they allocate about 24.5% of their total portfolio to real estate. And so, it's the second area of wealth creation outside where they, the primary industry where they made their wealth.
But you would say your main activity today, especially in the family office scene, is mostly multifamily. Is that correct?
We've been focused in on, quite honestly, industrial, and we're going to start doing some multifamily. Industrial, it's been on the cold storage side. We just see a real opportunity there. About 70% of the facilities are out of date. The average age is 47 years old. So there's a huge pent up demand. And multifamily, you know, you have to be extremely selective, but a lot of the fundamentals are still there.
Right. People say everybody needs a roof over their head, but at the same time, the industrial scene is booming like crazy. But a
Yeah.
lot of people, you know, talking to so many experts and have seen obviously deals myself. A lot of people say that the industrial, I would say, real estate industrial revolution is starting to get to a point where you have to be a lot more professional than it used to be, let's say, 5 years ago.
Mhm.
Do you see that also? What do you feel about that?
Well, anytime that you're going to have people focus on a property type, right? There's going to start being a level of sophistication that's added to it. I mean, look at self-storage, right? Long time self-storage would be like a lot of mom and pops, and then there started being the aggregation of properties, and along that improved management, right? Approved, locations and where they'd go. So, you know, the COVID really accelerated the interest and demand in industrial, quite honestly. So it's just getting more, there's greater awareness, and there is a level of, for the property type that's been stepped up a little bit. So I would say to some degree, yes.
So tell me something. When you come in, when you see an opportunity, you come in, you want to involve one of the family offices, or maybe some of them that are within you, and you want to involve a few of them together, whatever you guys do in your business. If you could give us a little bit of a vivid example of how it's done, meaning where you are in the deal, where you are in this transaction, your advisory, your part as a transaction person or as
Sure.
part of the GP or whatever you guys do. I'd love to understand exactly how it's done within your business.
Yeah, sure. So we've been focused strictly on co-GP opportunities initially. So we'll invest up at the GP level. And so with that, we look for GP economics. So, you know, that can be anywhere from 3 to 10% greater returns, getting those GP economics than if you were an LP, right? So first and foremost, we always go through and we underwrite the sponsor and the operator, because it doesn't matter how good the deal is if they can't implement. So that's the first thing that we do. And all of our due diligence is done in an institutional way, because that's what we've got experience on, is on the institutional level. So we'll do that, and then we'll come through and we'll do the analysis on the property itself. With multifamily, it's quite easy because you can do a market demand analysis that tells you exactly what the demand is, or if there's excess coming online, et cetera. And so then we'll underwrite the deal. We're allocators. So we're like an Apollo or a Blackstone. We're not going to be there on the day-to-day. We have experience, about $15 billion of experience in 50 years of multiple property types. And that's dealing in everything from development to, asset management to, across the board, even experience investing on behalf of some of the major institutions as an operator. So we now act as an allocator, and after we do the due diligence, then we'll go to our families and say, look, is this something you'd have an interest in, being a part of? And so on the GP side, you do have to do a fund, because you're writing checks of $1 million to $3 million at a time. So we do that in a fund structure. We're just doing that in the multifamily too, which is a co-GP in the multifamily. And then other industrial cash flowing, we're doing a GPLP type structure where we can get some additional economics in addition to the LP. And those are usually cash flowing assets, but we allocate, we underwrite, we kick out the deals that don't make sense. And so anything that we do bring to our families is already vetted.
Wow, very interesting. Tell me something. Because I know that you are based in Denver.
Mm-hmm.
First of all, what's special about Denver? Tell us a little bit about Denver.
Well, I can tell you this, is that, so when we came here 7 years ago, that we came here for my daughter's school. That's why we left New York. And but it reminded me of Seattle in the late 90s, because I lived in Seattle from 92 to 2000, and then back in 03. And Denver reminded me of Seattle in the late 90s. And one of the biggest ways I explain that is that in the 90s, Seattle was a town. Today, it's a city. Here in Denver, it's a town. It's not a city. And it's growing. The difference in Seattle and here is that you've got sprawl, where you can just go out, where in Seattle, you're restricted by water. And then we have 300 days of sun. And my friends used to say, yeah, 300 days of sun. I'm like, yeah, whatever. No, it's 300 days of sun and no humidity. Whereas in Seattle, 9 months out of the year, you've got overcast or rain. And so, and we're centrally located. I mean, you look on the map where Denver is, I am 3.5 hours away to any location in the US other than Miami. And so it's very convenient to get to all the places that you need to get within 3.5 hours. And then you've got the mountains. So it's just a great growing area.
Sounds amazing. Gives you the hunger to want to be there. A lot of people obviously know it from the skiing scene. In terms of the locations of the properties that you're looking at, is that cross country, meaning all over, or are you focusing in certain areas?
Yeah, so we focus on secondary markets, markets that have the fundamentals. You're looking at a Denver, a Salt Lake City, Dallas, Boise, Idaho.
Growing markets.
See, yeah, growing markets, because that's where you're going to get some of the better opportunities, but you're also going to get better returns.
Tell me something. To operate this, to source, to find the deals nowadays, it's a little bit more challenging, I would say. Would you agree? And what do you guys do for that in terms of the team that you have, in terms of how you get this done? I would love to hear the ratio of acquisitions that you have today versus, let's say, right post-COVID, meaning I'm not even talking about pre-COVID, like post-COVID acquisitions versus the today environment. What is there to find? How hard it is, and what do you guys do about it?
Well, it's always, it's definitely deal flow. Now, one thing I will tell you, I get asked to speak at a lot of conferences around the world, actually. And when you're going there and you're working for an actual single family office, you have a bullseye on your forehead. So you get people sending you deals all the time, right?
Yeah.
So one of the areas of deal flow, because I do get asked to speak a lot, is I'll literally be up in front of the whole room and say, this is what we're looking for. And that automatically
It comes to
opens up people. So they'll come to you and say, hey, right? Another way is through referrals, talking to other families. Who are you working with on this? Who have you invested with in the past on that? So from that perspective, and quite honestly, that's one thing good about conferences is that a lot of them will sponsor or pay money to have booths and stuff. And so it allows that conversation to say, okay, let's look into these guys where we might not have seen them before. And so it's really, and then networking through brokers. Right?
So you get in the deal flow, you're working with brokers.
Mm-hmm.
As you said, you have the bullseye. I'm a family office, I'm looking for deals and everybody's coming to you, but do you see also the differences in the caps in terms of the deals, or you don't see that much?
You've seen what's happened is like on the multifamily side, and people that follow that at all know that there are people that are buying now at 3.5, 4 caps, which is ridiculous, right? You're supposed to buy low and sell high. Well, technically, you're buying high and hoping that you're probably going to end up selling low. Now, once again, if the fundamentals are there, like there's a housing shortage here in Denver, so you're going to be okay, and you're going to get around that, and that's why it's so important to dive deeper. I think that when you're looking at the multifamily side, the issue that you have is you have a lot of players that have only been out there for 3 or 4 years, and they haven't been through a recession. They haven't been through a downturn. It's all been great. I mean, if you started investing in multifamily in 2012, if you didn't have good returns, there's something wrong with you, because everything's just gone up, right? So we have seen cap rate compression for sure on the multifamily side. You know, on the industrial side, any of the development that we've been doing, there's been the rising cost of construction, right? In cold storage, it's been harder to get personnel that you're going to have to hire because these are cold facilities, you know, they're cold to work in. But the cost of construction has definitely gone up, which has caused an issue. We have been on the industrial cold storage, if we're looking to build straight up, and we were able to build to about an 8 cap. Well, if the market's at, you know, a 4.5 to 5.5 cap, that's a pretty big spread, right? Now we model out at 5.5 to 5.75, but you've just got to go through more deals. At the end of the day, you got to go through more deals. Doing co-GP on multifamily is going to allow you to get those higher returns for sure.
Do you have a team to help you with that?
We do. I mean, we've got a small staff that we use, and then we also, you know, try to, anybody that we work with that's placing capital, you know, we'll work with those intermediaries, and we're like, this is our box, this is what we're looking for, which is same strategy as the institutions take, right? They're like, this is what we're looking for. If you have anything, let us know. And so that's what, you know, that's what we're doing. We try to get in our box as much as possible. And then ultimately at the end of the day too, you only want to work with a handful of partners so you can do multiple deals, and you don't have to keep underwriting the operator every single time.
That's right. That gets me to the next question. If you could give us a little bit, educate us a little bit about what is important to you when you're looking for an operator. The due diligence, you know, obviously you can't go over everything. This is something obviously that I remember that also we created a whole checklist of what we need to check when we are on the LP side or whatever. But whether you're LP or co-GP, doesn't matter. You still have to do due diligence on the operator. If you could please give us the ins and outs of what is important about finding that partner.
Well, a couple of things. One is that when you do a background check, you can find out a lot, right? And so you want to do it, you want to check in. So first and foremost, you just Google their name and you're going to find out. In fact, we did a due diligence the other day and we found out that one of the guys had been through, I even think spent some time in jail, right? So you're like, well, let's just stop right here.
It's amazing what you can find on Google. It's incredible.
It is. It really is. It really is. So background check, you know, if people lost properties during, which a lot of people gave them back in the recession, what happened? Why did it happen? Right? And what would you do differently? So we want to look at not only a background of them, but historically, what have they done? Have they been through cycles? Have they not been through cycles? Like I said before, you know, if you start investing in multifamily in 2012, well, you made money. Doesn't mean that you're a good investor. It just means that all boats rise in a, you know, rising tide, right? So, so we'll look at that. We'll look at the team. How long have the team worked together, and have they actually done deals together? What's their track record? Have they gone full cycle? Have they not gone full cycle? You know, what are some of the deals that you turned down that you didn't do, so we can get an idea of how they think, right? And then we'll also do site visits to meet with the actual companies. And, you know, it's about that relationship ultimately, right? Looking them in the eye and how do I feel working with these guys? And do I feel that we could have a relationship, especially when things go bad, which they will at some point in time. You got to be able to work through that. And so once we check all those boxes, then we start going into the property itself. And we start looking to how do they underwrite, right? Are they and are they saying that, oh, we're going to buy at a 4 cap and sell at a 3 cap? Everything we do is we expect a cap rate expansion of 20 bips every year. So if they were buying at a 4 cap or a 5 cap over 5 years, we're going to expect if they bought at a 4, what happens when they sell at a 5? Or if they bought at a 5, what happens when they sell at a 6, which is the same thing that institutions do, where they expect that expansion. And then we stress test and we say, what can they do? What's the bottom like? And then that's where we start diving into the local market comps, Anything we get from a broker, we don't usually will look at, but we have to do our own due diligence by diving in ourselves.
Tell me something. This is something I meant to ask you. You mentioned in the very beginning education.
Mhm.
You have an educational system for family offices. Tell us a little bit about that.
Yeah, so about 3 months into working, as I mentioned, with the first family, I only know 2 families. So I'm like, I've got to understand this marketplace, right? And it's not like there's all these books. At the time, there wasn't any books. Well, now there's more books to go into some of those details. And so what I did is I met a very key person in the industry, and I asked her, I said, so what have you been working on? And she goes, well, we just had 60 families in Israel. We did an event. And I said, what did you talk about? And she said, and I'll never forget this, she goes, oh, you know, hedge funds 101. And I'm like, hedge funds 101, what are you talking about? These are people that are extremely successful. These are people that are worth hundreds of millions, billions of dollars. And you're telling me that you're going over hedge funds 101? Well, the reality is that they've spent the last 40 years in chemicals, or they've been doing tires or pharmaceuticals, some other industry, right? And so when that happens, they just don't have the ability to understand all the various components. I think we talked about this before, hedge funds, et cetera. So I started by a simple website to provide education. That grew into a book that I wrote on family office real estate investing. Then I started doing some podcasts, some videos, speaking at various conferences, writing for Forbes on family office real estate, and started the Family Office Real Estate magazine, to which we've done 16 issues. Started the annual Family Office Real Estate study on investing and what families are doing, the largest of its kind. Then we went into a consortium event, and then I got asked by the University of Denver to do a Family Office Real Estate Institute. And what we've done today is we decided to branch off on our own. We partnered with IREI, Institutional Real Estate. They've got about 40 people for their back office, and they have publications on 3 continents. And so we partnered with them. Glenn Miller, who is, I consider, the grandfather of real estate market cycle. He's the academic director of the Ford Institute. And it's focused around executive education for families, family offices, industry professionals, family members. And we have executive education program with professors from Harvard and Wharton and University of Denver, University of Chicago. And then we just got approved for the Journal of Family Office Real Estate, which will be in universities around the world. We've got the magazine in there. We've got podcasts. We're going to have conferences, and it's not just based upon real estate, which if we're going over courses that are talking about the, asset allocation or investment management committees, et cetera, we're also talking about governance. We're also talking about what happens if you transfer the real estate business from one gen to the next. What happens if the patriarch dies and one family member wants real estate, the other wants different real estate, another one wants cash, right? How do you deal with these issues? Because 70% of families lose their wealth by the second gen, 90% lose it by the third generation. And so by providing this, and like I said before, 24.5% of a portfolio goes to real estate for a family on average. And it's the second area of wealth creation outside of where they created their initial wealth. So we're actually, providing that education, and it just spawned out a basic little real estate, or a little website, and that's where we're at today. So families are big on education. All of our programs are at the University of Denver, and then we also do them online. And there's a real demand. And so that's what we're doing. And I have yet to be able to find somebody that really understands the family office and the real estate side. And so that's where I'm really helping to with the programming, et cetera. And we've got an exciting board. I mean, we've got families represented from the owners of the Chicago Cubs to Paul Tudor Jones, Johnson & Johnson, Major Beer Company, Best Buy, Panda Express, Giorgio Perfume. So we've got a pretty heavy board also that helps with direction.
That's amazing and exciting. And It's incredible. What a world. What a world it is, the family office world, and the way to invest, the way to educate them and to come and help them with real estate. I think this is incredible. I want to shift gears a little bit. We started talking right before the show. We had a small kind of short conversation, and we've mentioned the world, which you are looking at also, the world of prop tech. Let's talk a little bit about that and maybe dive into some aspects, because that's also a very wide range of topics within the prop tech world. So let's focus on a few. But first, tell us about your thought about the integration of technology and real estate.
Well, real estate is always lags behind other industries. A lot of that has to do with because it's just antiquated and it's basic, right? Before we had, if you look back and you see the people that were running real estate companies, well, they always started as a broker, or they started as doing finance, right? Or they just moved up, a realtor, whatever the case was, and eventually they're running a company. Well, back in right around the recession time, we started having a lot of academics, MBAs that were getting hired and coming in, which started the professionalism of the industry, right? And things started to speed up the process. Well, what I got asked to speak at a conference, a keynote, and I said, well, let me do prop tech, and because I wanted to really understand it. And I walked away with that, and it ended up focusing on blockchain primarily. And I labeled the speech "The Future Disruption of Real Estate." People have no idea what's coming, because right now it's a paper shuffle where you fill out the paperwork, right? Gets sent, you might contact the title company, and then you've got the bank, and then you've got the lawyer, and then right? And so it can take 30 days, 60 days to close a deal because there's just so many people involved. Well, with blockchain, that gets streamlined. And so because it gets streamlined, it takes something that takes 30 days down to maybe, 3 minutes. Right? You're also gonna impact the realtors and the attorneys and the banks and everything, because it can just be streamlined all together with blockchain. And so that is a huge component of the future disruption. But then you start getting into, I did another speech recently in Sweden in the fall. They asked me to talk about the same thing, so I updated it. And I mean, at the time, I didn't understand these NFTs, and you look at like Decentraland and everything, and I was blown away that you're buying for millions of dollars properties online, right? I mean, you're buying land, and it's, how can that be, and people live in that world, but there's so many components from the currency type. I think the next step that you're going to see coming into play is going to be, crowdfunding. When you look at digitizing and using digital currency, all that is crowdfunding using a different currency, right? But then you get into aspects of various technology that makes property management more efficient, right? There's lending more efficient. There's everything that is just helping speed up the process. And there's companies all around the world that are doing this, and it's just going to continue to grow. At the end of the day, however, you do have a hard asset, illiquid, but then you've also got firms like Red Swan that's trying to make those liquid investments, right? Options. It's the younger gen. Family offices maybe invest 1% in the crowdfunding, and they don't invest really much in the digital at all at this time. So it's really your high net worth. It's not your family offices right now, but in the future, it's going to continue to be utilizing these resources and then using technology to streamline every other aspect of real estate.
So what you're saying now is so exciting, and obviously, I know it from the inside. Obviously, we know about property management, the whole aspect of property management that is being disrupting the whole real estate industry. It goes to construction tech, and obviously, it goes to the whole idea of what you've mentioned, blockchain for docs, which is basically securitized, and you moving docs from one another faster. It's all safe. And the
Yep.
other aspect of blockchain, which you've mentioned, which will turn eventually into digitizing, the properties, and to get into what we call tokenization, and
Yep.
to bring it to trading within an asset, and it's already happening now. There are a few companies that are doing it now. That's a different conversation, but this is something really, really exciting that is really happening. So everything you say is correct, and it will be really exciting to understand and see if large investors, whether they're institutionals or also the family offices, are going to go and join the party. It's a really big question. What do you think?
I can tell you this, is that when you look at Bitcoin and you look at Ethereum and whatnot, families have been slow to react, right? And once again, it's their own money and they don't want to necessarily risk it, right? However, when you start looking into some of this digitization, and like I'd mentioned a company called Red Swan too, that's doing that to provide liquidity and whatnot. If we did something with them, they're going to raise the money through the digital platform, but they'll write us a check to buy the property. So all it is a different currency, right? Which is actually more secure. And it also helps on a global basis, because now you don't have to worry about currency risk necessarily, right? You're investing into whatever that token is and say, so it's going to happen more and more. It's not that big a deal necessarily if there's coins that are created just for whatever your properties are. But the first tokenization happened here in Colorado in Aspen on a hotel. And they were going to take it public as a REIT. They ended up doing it on a token basis. The future with families is going to be based on the younger gens. The younger gens are the ones that will really grasp this and invest. It's not going to be your first generation, that are around today.
Incredible. What a conversation. DJ, thank you so much. I'll tell you something. This is an exciting conversation because it seemed like, meaning to compliment you, you're the type of guy who started with coffee and went into real estate and taught himself everything. And I guess we have some similarities with, meaning myself included. I came from being a teacher and got into real estate from teaching myself the business. And it seemed like you came in such, meaning so far, it's been a long way. New York to Denver, coffee to real estate, to family offices, to getting educating yourself now within the whole prop tech scene. It's very exciting. If you want to tell everybody where they can find you, if they have deals or other, meaning tell everybody. Obviously, you guys can look at the links below or above, but please tell us, DJ.
Yeah, so you can get in touch with me at dj@evergreenpropertypartners.com. My website will start going up again, which is just djvankeuren.com. So that'll be coming back up. We're just updating that as we speak. You can find me on LinkedIn. Those are probably the best ways to get in touch with me. If you do have deal flow, you feel free to share. If you've got investors that are looking for capital, let us know, because we're sitting on money. If it's a family that wants to invest with other families, then we'd love to tell you about our consortium. And of course, you can always go to the FORE Institute, FORE.institute, not .com, but .institute, FORE for Family Office Real Estate .institute, and you can find out all the various resources available for education on family offices and real estate, and you can sign up to receive additional information or be kept in the loop.
Exciting. DJ, thank you so much for being with us.
Thank you so much for having me, and I hope that we'll be able to do this again.
Yeah, for sure. Stick around. I'm going to say goodbye to everybody. You guys, I hope you guys enjoyed it and got so much from it, just as I did. And I'll see you in the next